In this episode, we break down Coca-Cola's latest Q1 2026 earnings report and compare it with last year's performance. With revenue up 12% and EPS rising 18%, the company shows strong momentum. But is it sustainable? We analyze key financials, growth drivers, and potential risks investors should watch. FinTalk. Simple, clear, and focused financial insights.
So, last quarter, the Coca-Cola company sold only like 3% more actual liquid than they did the year before.
Right, just a tiny bump in the actual volume of drinks going out the door.
Yeah, exactly. Just 3%. But their net revenue, that exploded by 12%.
It's massive.
It really is. It hit $12.5 billion in a single quarter. And their earnings per share jumped 18% to 91 cents.
Which is just a wild discrepancy when you think about it.
Right. I mean, how does a company that's been around for over 130 years sell almost the exact same amount of beverage, but somehow walk away with billions more in the bank?
Well, that is the central paradox of their Q1 2026 earnings release.
Yeah.
When you dig into the data, you realize you aren't just looking at a corporate ledger, you are looking at a highly aggressive psychological playbook.
Oh, totally.
They are essentially engineering revenue growth without needing you to drastically increase your fluid intake.
Okay, let's unpack this. Because the mission of this deep dive isn't just to recite spreadsheet numbers, you know?
Right, nobody wants that.
Exactly. It's to decode how a massive legacy brand maneuvers through global economics and health trends and local cultures to create this sort of invisible nudge.
A nudge that most people don't even notice.
Exactly. So I want you, the listener, to think about the last time you bought a packaged drink.
Keep that in mind as we talk.
Yeah. Did you grab it purely out of biological thirst? Or did the package size, or maybe the location in the store, or even a specific cultural holiday push you toward that exact transaction?
Without you even noticing.
Right.
And to understand that invisible nudge, we really have to start with how they behave on a global scale.
Right, the macro view.
Exactly. So CEO Henrik Braun's commentary in the report, it focuses heavily on staying close to the consumer.
Okay.
And, quote, executing locally.
Which, I mean, that sounds like standard corporate phrasing.
It does, yeah. But it reveals a crucial strategy. The company basically operates as a hyper-local chameleon.
A chameleon. I like that.
Yeah.
Because they are this planetary behemoth, right?
Right.
Yet they try to mask themselves as a neighborhood sponsor.
Exactly. They blend right in.
And the report details some of these hyper-local campaigns. The sheer scale is just staggering. Like, take China during the Chinese New Year.
Oh, that was a huge one.
Yeah. They launched a campaign blending traditional Chinese paper art with an AI generator.
Right, so consumers could scan the packaging, right.
Exactly. They scan it to create customized digital family portraits. Or look at the holy month of Ramadan.
Yeah, they had massive activations there.
They really did. In Turkey, they ran a digitally led campaign where users shared recipes to trigger chef-led food donations.
Which is brilliant engagement.
It is. And then in Indonesia, they paired Fanta with nighttime celebrations for families breaking their fast.
Oh, wow.
And in Egypt, this is the crazy part, they literally set a Guinness World Record for the most community meals served in 1 hour.
Which just shows the scale we're talking about. And we see it in the West, too, you know?
Right, it's not just overseas.
No, not at all. Sprite saw double-digit volume growth in Brazil, driven directly by activations around Carnival.
Double digits just from Carnival.
Yeah, directly tied to it. And in the United States, they leveraged the March Madness basketball tournament.
Oh, the Fan Work is Thirsty Work platform.
Exactly. They paired the flagship Coke brand with body armor at music festivals during the tournament. They are aggressively attaching their products to moments of high emotional intensity.
Okay, but I have a really hard time believing that an AI paper art campaign in China or, you know, a Guinness World Record for meals in Egypt actually moves the needle on a $12.5 billion quarter.
It sounds like a stretch, right?
It really does. I mean, prove to me this is a financial strategy and not just highly expensive PR to make a massive corporation look warm and fuzzy.
Well, what's fascinating here is that it's a totally valid skepticism, but the underlying mechanism relies heavily on behavioral economics.
Okay, how so?
Specifically, habit looping and reciprocity. By embedding the brand into culturally meaningful occasions, like a family meal during Ramadan or, you know, a massive celebration at Carnival, they aren't just buying a billboard.
Right. They're part of the event.
They are wiring the brand into the emotional memory of that event. And the report explicitly states that these activations successfully increased their weekly drinkers.
Wait, it literally says that?
Yes, it drove global value share gains in total non-alcoholic, ready-to-drink beverages.
Hmm.
So when you give a community a massive meal or enhance a family gathering with an interactive digital portrait, you trigger reciprocity.
I see. So the consumer subconsciously repays that cultural goodwill.
Exactly. They repay it during their routine grocery run a week later.
So they use these massive cultural anchors to build a habit, and then the consumer reaches for a drink.
That's the playbook.
But there's a glaring hole in that strategy, I think, if we assume everyone is just drinking classic cola.
Right, which they aren't.
Exactly. What happens when that consumer decides sugar is the enemy? Because that 3% global volume growth we mentioned earlier, it is absolutely not just coming from red cans of Coca-Cola.
Not at all. And the portfolio breakdown in this report paints a very distinct picture of shifting global dietary habits.
Yeah, they'd be in trouble otherwise.
If they only sold traditional soda, they would be incredibly vulnerable to the very health trends you just mentioned.
Here's where it gets really interesting. Let's look at what is actually growing.
Okay, let's break it down.
Coca-Cola Zero Sugar is the undeniable powerhouse here. It's up 13% globally across all operating segments.
13% is massive for a brand that size.
It is. And Diet Coke and Coca-Cola Light grew 6%, mostly driven by North America.
Right.
But then look outside the carbonated space entirely. Tea grew by 8%.
Wow.
Yeah, with massive jumps in Europe, the Middle East, Africa, Latin America, and the Asia Pacific. And water grew by 5% across the board.
We do have to note, though, a slight 1% decline in their juice, value-added dairy, and plant-based beverage category.
Hold on, let's clarify value-added dairy really quickly, because that sounds like a terrifying science experiment.
Yeah, it does sound a bit clinical. It's just industry terminology for dairy products that have been modified for a specific nutritional benefit.
Oh, okay. Like what?
Think of ultra-filtered protein milks like Fairlife.
Got it.
So that entire category, along with juice and plant-based, dipped 1%. But the report notes this was largely driven by declines in the EMEA region and a specific structural change.
Which change was that?
They sold off their finished product operations in Nigeria back in the fourth quarter of 2025.
Okay, so that skews the numbers a bit.
Right. But the broader trend is clear enough. Zero sugar, tea, and water are driving the volume.
I look at that diversification, and it reminds me of an investment portfolio.
That's a great way to think about it.
It is like they are operating as an index fund of human thirst.
An index fund of thirst. I like that.
Right. Because an index fund doesn't bet on one single tech stock. It captures the growth of the entire tech sector.
Exactly.
Here, if consumers completely pivot away from carbonation to pee, the company doesn't panic. They just capture the growth.
We were ready for it.
If sugar falls out of favor, they capture the pivot to zero sugar. They have essentially hedged their bets against whatever a human being might want to drink on a Tuesday afternoon.
It acts like an index fund, sure, but with one massive difference.
What's that?
Coca-Cola actively controls and shapes the market they are indexing.
Oh, right, because of their sheer size.
Exactly. They don't just passively wait for tea to become popular. They leverage their massive distribution network to ensure their tea brands dominate the shelf space right as consumer interest peaks.
They dictate the choices.
Pretty much. They manage all the back-end complexity of dietary shifts so that the consumer never actually has to leave their ecosystem.
You want a protein milk? They have it.
Yeah.
You want an electrolyte sports drink for March Madness? They have body armor.
Exactly. You stay in their world.
All right, so they have the localized marketing, drawing people in, and the diverse portfolio keeping them in the ecosystem.
Right.
But we still need to solve the core math mystery. 3% more liquid sold, 12% more revenue generated.
Golden question.
Right. To understand that, we have to look at what the corporate world calls revenue growth management.
Yes. Revenue growth management is where the real leverage exists. The report attributes a significant portion of that revenue jump to a 2% growth in something called price mix.
Okay, let's translate that for the listener, because price mix sounds like the kind of term invented in a boardroom, specifically to avoid saying, we are charging you more money.
It definitely softens the blow.
What does it actually look like in the grocery aisle?
Well, price mix certainly includes straightforward price increases, but the mix part is where it gets highly strategic.
How so?
It is about changing the assortment of the packages they sell to prioritize items that yield a higher profit margin. It's essentially a game of global Tetris. You adjust the size, the shape, and the material of the packaging differently in every single country.
Just to extract the maximum possible revenue from every ounce of liquid.
Exactly.
And the examples the report provides of this Tetris game are pretty revealing.
Oh, and they're fascinating.
Like in the Philippines, they pushed single-serve Coca-Cola zero sugar packs and saw double-digit growth.
Huge win there.
And in North America, they pushed single-serve mini cans into convenience stores, driving high single-digit volume growth.
Right, the mini cans are everywhere now.
Over in the UK, they launched a premium 500 milliliter superfan can with Premier League packaging.
Tying it to sports again.
Yep. And in Thailand, they literally bundled drinks with collectible glassware to drive at home volume. They're aggressively pushing premium specialized packaging.
While simultaneously doing the exact opposite in other markets.
Wait, really? The opposite?
Yeah. Contrast those premium mini cans with what they are doing in South Africa and India.
What's happening there?
In those markets, the report highlights the expanded use of ultra-lightweight bottles.
Oh, right.
Which successfully supported volume growth. They strip out material costs where consumer affordability is the primary hurdle, and they push premium, high-margin packaging in markets where consumers have more disposable income.
I need to push back on the mini can specifically, though.
Okay, go for it.
As a consumer, I look at a mini can in a convenience store, and I look at a massive 2-liter bottle sitting right next to it.
Yeah.
Often, the mini can costs almost as much as the 2-liter, despite having a fraction of the liquid.
It's true.
Aren't they essentially just tricking consumers into happily paying more money for less product?
If we connect this to the bigger picture of consumer psychology, they aren't tricking you. They are solving a fundamentally different problem for you.
A different problem. How is it different?
Well, a 2-liter bottle solves the problem of bulk affordability for, say, a weekend party.
Sure.
But a mini can solves the problem of portion control. It offers a quick, perfectly chilled refreshment without the calorie commitment or the guilt of a full-size soda.
Okay, I see.
Consumers are explicitly demonstrating that they will pay a massive premium for the convenience and the psychological comfort of a smaller package. It is highly aggressive packaging psychology.
It's the exact same liquid, but the aluminum shell dictates the perceived value.
Exactly.
Now, before we move off the math, there is a weird logistical quirk in this quarter's numbers that we absolutely have to cover.
Oh, the extra days?
Yes. The report notes that concentrate sales were actually 5 points ahead of unit case volume.
Right.
The reason? The first quarter of 2026 randomly had 6 extra days compared to the prior year.
Which perfectly illustrates the mechanics of their supply chain.
Yeah, explain that for us.
So the Coca-Cola company does not actually bottle most of its own drinks.
Most people don't realize that.
They really don't. Primarily, they manufacture the proprietary syrup, the concentrate, and they sell it to massive independent bottling partners around the world. Those bottlers add the water, package it, and sell the unit cases to retailers.
So because the corporate reporting quarter was technically 6 days longer, corporate had 6 extra days to sell giant vats of syrup to their bottlers.
Exactly.
And that artificially inflates the top-line revenue slightly ahead of the actual consumer sales happening on the ground at the grocery store.
Yep.
I mean, 6 extra days of global syrup sales is a mountain of cash.
It's massive, and it reminds us that there are 2 layers of sales happening simultaneously, selling concentrate to bottlers and bottlers selling actual drinks to consumers.
So we see this revenue growth management strategy working incredibly well in places like North America.
Definitely.
Operating income in North America was up 20%, heavily fueled by this pricing power and organic revenue.
A huge jump.
But running a global empire means dealing with fractured economic realities. You cannot treat the entire map the same way.
You absolutely cannot. North America is the profit engine, thriving on premiumization. But the Asia-Pacific region presents a drastically different dynamic in this report.
Right, Asia-Pacific is the anomaly here.
It really is.
Unit case volume, the actual amount of drinks purchased by consumers, grew by 5% across all categories.
Which is great.
It is, yet their price mix declined by 6%. The report points to unfavorable mix and affordability initiatives.
Right.
The end result was a 14% drop in operating income for the region.
And this is what macroeconomic pressure looks like in real time.
Explain that.
Well, in the Asia-Pacific region, to keep that 5% volume growth alive, meaning to keep actual human beings habitually buying their drinks during tough economic conditions, they had to deploy those affordability initiatives.
So they made it cheaper.
They actively suppressed prices and shifted the package mix toward cheaper, lower margin options.
So what does this all mean? They are essentially playing two entirely different sports at the exact same time.
Yes.
In the West, they are playing a game of margin maximization. They push mini cans, they raise prices, and rack up profit.
Exactly.
But in the East, they are playing a defensive game of volume retention. They are willing to make less money per drink just to make sure the consumer doesn't abandon the brand entirely.
This raises an important question about the discipline required to run a global operation.
What do you mean?
It would be incredibly tempting for a corporate executive to force a North American pricing strategy onto the Asia-Pacific market.
Just to try and fix that 14% drop in operating income.
Exactly. But if you do that, you price out the consumer entirely. You lose your weekly drinkers.
Right.
They are choosing to take a short-term hit to regional profitability in order to protect their long-term market share.
And looking toward the long term, what does the rest of the year hold? Because the report includes their 2026 Horizon outlook.
The company expects 4 to 5% organic revenue growth for the full year.
Let's define organic revenue for listeners so we aren't just throwing jargon around.
Good call. Organic revenue simply means the money they make from their core day-to-day business operations.
Okay.
It strips out the noise of wild foreign currency fluctuations, and it ignores the financial impact of buying or selling other companies.
So it's just the basics.
Right. It is the purest measure of whether their fundamental strategy of selling beverages is working. And they expect that core engine to grow 4 to 5%.
However, they are also preparing for a massive structural change.
Yes, a big one.
They project a 4% headwind to comparable net revenues due to acquisitions and divestitures. The big one mentioned here is the pending sale of Coca-Cola Beverages Africa, or CCBA, expected in the second half of 2026.
Which ties right back to our earlier point about the supply chain.
How so?
They are offloading a massive bottling operation. They want to hold on to the high-margin intellectual property, the brand, and the concentrate,
Right.
and let someone else handle the capital-intensive, heavy lifting of running the bottling trucks and factories in Africa.
Okay, that makes sense.
It will lower their top-line revenue because they won't be counting those bottling sales anymore, but it makes the core corporate structure leaner and more profitable.
So to wrap this up, the $12.5 billion they pulled in during Q1 2026 was not a sudden organic surge in global thirst.
Far from it.
It was the output of a meticulously executed machine. They utilized AI and world records to create hyper-local cultural habits.
Yep.
They captured shifting dietary trends by ensuring zero sugar in tea were heavily stocked.
Exactly.
And they deployed highly aggressive packaging psychology to convince consumers in the West to pay a premium for portion control while stripping costs in the East to defend their market share.
It is a profound lesson in how modern legacy companies operate.
It really is.
They aren't just selling a product, they're selling the exact package at the exact price point tied to the exact cultural occasion that a specific demographic demands on any given day.
So the next time you are standing in a convenience store, looking at the beverage cooler, whether you reach for a premium mini can because it feels like a guilt-free treat, or you grab a uniquely designed Sprite bottle during a local festival, remember that your decision was anticipated.
Oh, 100%.
You are interacting with the end result of a globally calibrated revenue growth algorithm.
And as technology improves, the precision of that algorithm is only going to increase.
That's a slightly terrifying thought.
The distance between the brand's data collection and your personal preferences will shrink dramatically.
Which leaves us with a final thought to ponder. We already see them using AI to instantly generate personalized digital paper art on packaging in China.
Right.
It is highly customized marketing on the exterior of the can. But how long will it be until the actual flavor formulation inside the can is dynamically adjusted?
Wow.
Imagine walking up to a smart fountain at a cultural festival and an AI mixes a beverage on the spot.
Like completely tailored.
Yes. It perfectly tailors the sweetness, the carbonation, and the electrolyte balance to your personal health data and your exact dietary needs that day.
That's wild to think about.
If they have already mastered customizing the psychological package. How long until they completely customize the liquid itself? Think about that the next time you pot a tab.